The Aberdeen China Investment Company, which seeks to gain capital appreciation by investing in all Chinese companies, regardless of where they are listed over time. And the market over the last quarter has been challenging. It staged a strong rally starting in the second half of May, and that was driven by the sentiment improving due to Shanghai coming out of the COVID lockdown. And the government also announced a number of supportive measures, such as the 140 billion renminbi tax rebate for the corporate sector and the 60 billion reduction in purchase tax on passengers' vehicles. The central bank, which is the People's Bank of China, also announced further cuts to the interest rate in order to support the small and medium enterprises. However, in July, COVID resurgence in multiple provinces again started to take center stage. In addition, news of mortgage payment suspensions from home buyers of unfinished residential projects across China poured cold water on the market as it raised questions or concerns regarding a prolonged property down cycle. And of course, the banking sector was also affected by potential contingent risk. As a result, the market gave up almost all of its second quarter returns or gains. However, if you look at the first half company results, they have been generally better than feared. Most of our holdings delivered in line or better than expected results. Like the rest of the world, the China A share market was not spared the risk of correction in September. This was on the back of a more hawkish projection for interest rate from the US Federal Reserve and an outlook of a global economic slowdown. Now, coming to the trust itself, the trust third quarter 2020 return was a negative 14.35%. This was 76 basis points behind the benchmark. So what worked for us and what did not? Firstly, let's look at what worked for us. The top performers or the contributors to performance for the trust were as followed. Firstly, the first being Sungrow Power Supply Company. This is the world's leading solar inverter maker. It rallied on the back of a positive outlook for its energy storage business. Hefei Meiya. This is the second contributor, the largest contributor to the trust performance. It is a leading dental CT scan equipment maker. The stock rose on optimism of a weaker renminbi that could help its export business, as well as data or trend showing an increased penetration of demand for dental care in China. The third stock that helped our performance was Proya Cosmetics. This is the leading Chinese cosmetic skincare company. Stock gained after a very good set of results. This is the first half results that I'm talking about. And the result was driven by higher gross margin, which was a testament to its effort to climb the value chain in terms of its product pricing or product value. Now, what did not work for us? The first the biggest detractor to performance was Sifi Ever Sunshine. This is the property management company of the parent group called Sifi. Now, the share price fell due to problem at the parent level, as the parent is facing increasing liquidity risks amidst the prolonged real estate slowdown in China. Now, the second detractor was China Merchants Bank, and this is the leading retail bank in China. Share price of the company fell as a result of rising risks on the potential contingent risk from the weakness in the real estate, as well as credit demand being lower than the year before. We have spoken to the bank about the real estate exposure, and we are glad to report back that the risk of a slowing real estate to its lending to its loan book is not high, and the risk is well managed with very high provision made by the bank. The last stock that I want to mention here that detracted from performance was China Meitong Auto. This is a luxury car dealer that suffered from a weakening demand due to a slowing economy. But we believe that it has a very big market share in the lower tier city where the demand for luxury cars will return as the economy recovers. Yeah, in terms of the portfolio activity in the trust, we initiated three names. The first being Glodon Software. It is the leading IT solution provider for the basic construction industry. It is benefiting from a lot of the users of construction software moving onto the cloud computing on a cloud, and that is a trend that continues to benefit the company. We like its strong market share in this area. The second company that we introduced was Yunnan Energy. This is the leading lithium battery separator producer in the world. And lastly, we also introduced NetEase, a leading game developer with an expanding global presence. You may say that negative market sentiment might have weighed on its share price for some time due to regulatory pressure, but we believe that the fundamentals are very much intact, and the weakening sentiment on the internet sector as a whole gave us the opportunity to invest in one of the leading game developer in China. Now, in terms of where we have cut our holdings or even exit from the trust, we took the opportunity of market irrational optimism on some of the automation names by taking profit in a company called Astent. We thought that the sentiment on this name, on the automation sector in general, had run ahead of the fundamentals. So we took the advantage of the strength in the share price to take some profit. We exited an electric vehicle charging station maker called Qingdao Teagood Electric Company. The conviction on the name waned amidst rising concern over the transparency of its accounting policy. So we took the decision to exit from this position. On the ESG front, I just want to mention here that the abrdn China Investment Company has a higher rating based on MSCI now. It is rated BBB, which is a notch higher when it was rated back in May from BB to a BBB. This is higher than the benchmark of the BB. Now, we can also share with you that some of the engagement or the results of some of the engagement that we have had with companies that we invest in, and that is starting to show results as well. And this company that I want to share with you is China Tourism Group Duty Free Corporation. This is the largest duty-free retailer in China. It has set an impressive plan to upgrade their ESG rating in the next 2 to 3 years. And this was backed by the board of directors of the company. So definitely an example of a Chinese company wanting to improve on their ESG standards. Well, let me turn to the outlook for the Chinese market in the near and the long term. Currently, the Chinese stock market continues to be hamstrung by two main concerns. First, visibility of the government's pathway towards the easing of its zero COVID policy. Second, the recovery of China's real estate sector. Now, on the policy regarding or the easing of the zero COVID policy, it is difficult to get insight on the government strategy and the pace of reopening. However, there have been encouraging signs of policy easing, such as the shortening of the quarantine period for inbound travelers to mainland China, as well as the endorsing of the Hong Kong's removal of a hotel quarantine requirement in October. So there has been a lot of speculation on the timing of the reopening, but we believe that the process will be a cautious and a gradual one. On China's real estate sector, firstly, we want to give credit to the government for persisting with the deleveraging of the sector. It is a difficult act, and we cannot ascribe a zero probability to a hard landing scenario, potentially caused by a loss in home buyers' confidence in the sector. However, we believe that the government has the levers to prevent a systemic-wide meltdown in real estate that could affect not just the real estate but as well as the banking sector. They could do this, based on a number of measures, such as making it more attractive for second home buyers, the upgraders, to buy a second home for upgrading purposes. He hasn't been able to execute some of this policy very well, partly due to the uncertainty related to the personnel at the top. Now, China is going through a leadership change, not just at the top level, but also at the government ministry level. And with the personnel not being confirmed, it is challenging for the government to execute some of these policies. So we believe that after the 20th Congress in October, we should see better execution of some of these supportive policies. Lastly, amidst the macroeconomic pessimism, earnings at our trust companies level continue to hold up very well. Valuation, on the other hand, have reached historical low. So I would say that this is a good opportunity, and we remain buyers of Chinese equities, especially opportunities in the 5 investment themes that we have identified. And these are aspiration, digitalization, going green, healthcare, as well as wealth management. These investment themes, they have multiple years of growth potentials, and these are the areas that are well supported by the government in the face of the US-China competition or tension that you're seeing today. Thank you.